big ET Now exclusive then, and there have been concerns about HDFC Bank's growth since the bank released its earnings last week. But the management remains optimistic as top sources have shared their plans for the future with ET Now's Ajaya Sharma. Let's go across to him for more exclusive details.
Well, this is a very important story which we've been all tracking for last few days, and that is the relentless selling in HDFC Bank ever since the earnings actually came out, which was not liked particularly by the street. India's largest private sector bank saw massive selling and continuous downtick ever since the earnings were released, and a lot of brokerage notes spoke about potential derating certain section of the market. Also put out that the stock may actually go in for a sideways movement for a long time. Our sources at the top management at HDFC Bank, we gone ahead and actually sought to find out what exactly has happened in this particular quarter. We are picking up from our sources that the pressure which was seen on growth slowing down, on profitability, giving even indication that perhaps asset quality could also come under pressure, are actually because of the sudden changes in the environment which have happened. The macro environment has gotten tighter. Mobilizing deposits has been quite challenging. In fact, liquidity overall in the system has gotten tight, and that actually is leading to a lot of pressure as far as when will the merger benefits start showing. This is the first result when the combined balance sheet of HDFC Limited and HDFC Bank has actually been at work. So we are picking up that rates actually have caused a bit of a havoc on the deposit cost of borrowings. Also, HDFC Limited's borrowings are pretty elevated. We understand from our sources that HDFC Limited front-loaded or brought forward a lot of borrowing, almost 1 lakh crore, and that actually weighed as far as the borrowing cost of the merged entity is concerned. We understand that there is no structural slowdown as far as the merged entity is concerned. In fact, right now the management of the entity is focusing more on trying to bring in the cost of borrowing lower, trying to ensure that NIMs actually are maintained or even go higher, and the focus is on profitability. They expect the benefits of the combined entity merger to start showing in a major fashion in the next 2 to 3 quarters. So they believe that, just like as we say in cricket parlance, that class actually is permanent, form actually is pretty temporary, and HDFC Bank may have gone out of form temporarily, but it is not out of complete the class, which the class apart bank it actually has been for investors across the country. Also, we are picking up that on the branch expansion fear of the market, they are not slowing down the branch expansion. Even now, the bulk of deposits are actually coming from seasoned branches. So the fear that if the branch expansion is brought lower, that means mobilizing deposits in future will be difficult, is also something which actually markets may be going ahead of itself and thinking about. So in the near term, bringing down costs, focusing on margins is the focal point of the top management. In the next 2 to 3 quarters, they expect the growth to come back, and deposits also, the growth in deposits also to rebound. Even now, we understand from our sources that the combined entity is continuously gaining market share in the market, even in this kind of a tight market for liquidity. So they are pretty confident at the top management level that in the next 2 to 3 quarters, things will revert back to normal, and a reasonable growth with quite healthy margin outlook and NIM outlook will actually prevail. So that's what we are picking up from our sources at the top management.